Hello, ladies and gentlemen. Good evening, everybody. Tonight is a special episode because it's all in English language. I know it's a long time. I don't have an interview in English. My English is a bit rusty, so please forgive me. And why are we doing this in English? Because tonight I have a special guest, which is a long time dream guest of mine. And I'm, of course, talking about Cameron Passmore, which is the co-host of Rational Reminder podcast and also chairman of PWL Capital. And without further ado, let's say welcome to Cameron. Hi, Cameron. How are you doing?
I'm great. Great to see you, Giorgio. Thank you for the invitation. Frankly, I'm jazzed about this. Very exciting. And it's so good to see you again. You were such a great guest when you joined us on our podcast. We had so much fun.
That's amazing. That's amazing. Thank you so much. I'm really honored, and I'm excited. Sorry, I need to calm down. I need to calm down.
Man, how can we not be, right?
Yeah,
this interesting stuff we're going to talk about. It's such a great time to be alive. There's so many great things going on.
Amazing. Cool. Can you help us introducing yourself a bit?
Sure. Personal or professional or combo of both.
Oh, let's start. I don't know. You decide. You pick one.
I mean, our connection is through my day job. So I'm not a big fan of titles, but I'm formally the executive chairman of a company called PWL Capital, which is a private investment management and financial planning firm in Canada. I'm based in Ottawa. We have team members across the country. So we're an independent, privately owned, employee-owned company that provides complete wealth management services to our clients. We have about 1,250 families that we help with their wealth management.
250?
1,250, yeah.
1,250. Okay, wow.
So we're considered we're still small compared to the banks, but we're considered a large independent. We're large enough to be able to build out a full complement of team members, but we're small enough that we still know all of our clients and we can do very personalized service. And through the pandemic, we're able to, largely through the podcast, actually attract a lot of great talent to join our team. So we've largely gone virtual. I'm in our office in Ottawa, but most of our team members work virtually from British Columbia.
Canada?
All from Canada. Yeah, we all work in Canada for Canadians. We're registered in Canada. So we're formally an investment brokerage company. So I started my practice back in 1991, if you can believe it. So it's 30 plus years. And
wow.
The team we were small for the first 20 years or so. And then in the past decade, we really had some lucky events happen in our world and we were able to grow quite dramatically, especially over the last 5 years. So now we have 75 people on our team, which is
75 people.
Yeah, it's been an incredible experience. Yeah.
So let's say that I will start telling you that I'm on a personal fight, let's call it fight, against the Italian financial advisory industry. So I hope we are going to show people how things can be done differently. Before doing that, I want to just say that this podcast is not sponsored by anybody, not even by PWL Capital. So it's not like a paid sponsorship. It's like just me wanted to talk with Cameron. And so you joined PWL Capital back in 1997?
7, yes.
7, but you started in 1991 with this in this industry. So
Correct.
Before PWL Capital, what did you do actually?
So I grew up, I was a butcher as a kid in small town Quebec. And I ended up getting accepted to go to McGill University, which for me and our family was a pretty big deal. And I ended up graduating from McGill in commerce. And I was in commerce. So I have an undergrad in marketing and entrepreneurship. And I ended up being approached, at the university, like companies come through, and one of the big beef packing companies in Canada came in and said, "Oh my gosh, we got a business grad who was also a butcher." So I was offered a job on the spot, and I was so thrilled to get a job in a company car. I took it. So I sold beef for a couple of years.
Wow.
but quickly realized that selling commodities was hard to add value to, like beef. It's a pure commodity. But and I've got my cow up on my wall here, as you can see. I a lot of similarities to being in a butcher shop, believe it or not, to what we do in the.
Then you move to where the real meat is.
It's different meat, right? But it's not a commodity, which is what's the beautiful part about it. We're able to add value to something.
Sure.
And have a relationship. Believe it or not, when you're in a small town butcher shop, you actually have a relationship with your customers, right? You know what's going on in the world. You know if they're having a special company, they have a special cut they want. So I jokingly say, like, I'm kind of in a modern day butcher shop doing financial planning for people.
It's a very tailored service.
Very tailored, very relationship oriented. You really get to know the people. And the team environment here that we work in is much like the environment in this small town butcher shop, right? I'm not a big fan of titles. It's like we all work together to try to do the best thing collectively as we possibly can for the end customer.
And what brought you to the financial advisory industry?
I was tired of selling a commodity, and this in the early 90s, mutual funds were just becoming popular. Canada created, I think, the deferred, what's called the deferred sales charge, which is you get paid a commission to sell a mutual fund. And I quickly learned the math that if you sell $10,000 of a mutual fund, you make $500. So it was, and I'm not proud of my roots. I'm proud I came through it and what I've accomplished, but I largely joined to sell something else. Instead of selling a cow, you're selling a mutual fund. But there was
so
no
essentially
training.
Canada in 1996 was like Italy's today, because today there's still like people who join the financial advisory industry because, hey, you can sell a mutual fund, an active fund, and ask 3, 4, 5% upfront fees plus like recurring fees. So yeah. But luckily for us and for your customers, then you PWR Capital like has a completely different business model right now.
Well, so I started in the commission business and realized, like, okay, if I sold $100,000 investment, I'm making $5,000. If you sold a $500,000 investment, you make $25,000. It's like, this didn't make sense. So I quickly decided that I want to get into what was just being born, the fee service, fee for service, paid a management fee. So I then, along with my partners at the time, discovered the founders at PWL Capital in the mid 90s and said, we can go to this fee-based environment where you avoid all the commissions, right? And commissions came from selling active mutual funds, which I know you know all about. Yeah. And so we came into this fee-based world, stopped charging commissions, stopped getting the trailer fees, and you got paid by the client. So you disentangled the payment of advice from the delivery of the product. So
that was already in the mid 90s.
That was 96. And we were told at the time, you better do it fast because fee base is coming. Well, that didn't happen for a long time. So we were way ahead of the curve. But the next interesting thing that happened, and Canada was the first to come up with an ETF. ETFs actually started in Canada. Yeah,
I don't believe that.
The idea was created in the U.S., but Canada was implemented on the market in ETF. So the ETF revolution, the indexing revolution, started in Canada, and it's incredible. Once you take away your compensation and you're paid by the client, all of a sudden, all the reasons why indexing makes sense, they open up to you because index funds didn't pay a commission. ETFs don't pay a commission. So if you're paid by the client,
small one.
In our world, they don't. There's no compensation for us to do to ETFs.
Sure.
But we used to be trained in the old active world why indexing didn't make sense. And of course, they're all nonsense, but we used to accept this.
Wait. This is actually new to me. So you were trained to believe in the fact that index fund. I recently read a study that was based on Canadian financial advisors, and they discovered that actually like a large percentage of Canadians financial advisor up until 2012 probably, they actually owned in their own portfolio the same crappy active funds that they were selling to customers. So they weren't like evil in putting this thing into their portfolio. They actually believed that.
Yes, the intentions are good, just the knowledge was low. And I think the vast majority of advisors still believe in active management, and they believe that's a big part of their value proposition. We just don't share that view. But once you disentangle the compensation, it's like everything opens up. This makes so much sense, right? You can look at the evidence objectively because you're not paid to sell something else. And that happened at that exact time. Like the late 90s, ETFs became popular, indexing became popular, and it was quite incredible time. And we know what's happened to the ETF marketplace since then. It's absolutely exploded. Indexing's exploded. Awareness has exploded. And that's why I say it's such a great time for consumers in this marketplace if they're aware of these great ideas and products and tools to do this.
So let me recap so far. So in Canada, in mid-90s, ETFs were born. Like in Europe, things happened like at the end of the first decades of this millennial. So actually in 2009, the first 2008, 9, and financial, you were trained back then to believe in the fact that active funds were better. What were? Do you remember which was the main argument pro active management? It's like you can beat the market. The index are risky because if the market falls 50%, you lose 50%. But what we are active manager.
Now, when I say trained, I don't mean trained by the industry. I mean the regulatory bodies. I mean trained by the industry or sales companies.
Sure.
But it was like, Giorgio, you don't want to be average.
Sure.
Why? Like nobody wants to be average, of course. So we can choose the stocks and beat the market, which is, of course, intuitive.
Sure, everybody beats the market. Yeah.
Well, and that's mathematically impossible.
Yeah.
Right. The Sharpe's arithmetic of active management. But those were the very common arguments, right? But it all came down to compensation. Index funds did not pay a compensation or a commission.
So let's see how PWR Capital expanded, survived. It's it's not the perfect word. Like you actually thrived. You are thriving in this with this business model. So you joined PWR Capital back in 1997, if I remember correctly. And how was it back then?
Oh, the company was very small when we joined. I consider myself a near founder. I joined about a year after.
I thought you were the founder, but actually I then discovered you were not. You joined the year 1 year
after. So it was very small. But the three founders were visionaries, right? They wanted to integrate the planning, which is what really mattered. They were planners at heart, but they wanted to integrate the planning with the implementation of portfolios. Mm-hmm. And that's where our hearts were as well. We're passionate about the planning and the people. And that's where the meeting of the minds was. It wasn't so much about indexing, because indexing was just really starting. The awareness was just starting, but we were not all on that page in the beginning. Mm-hmm. And those are still the roots of the business. I think most people come to us, and a big part of what people value is the planning and that relationship to help people think through their financial decision making. Now, I think a lot of people do come to us because of the markets work philosophy, call it indexing, call it efficient market hypothesis, for that framework of thinking. A lot of people come for that, but you can get that cheaper. You can avoid our fees by going direct to a robo or an ETF on your own. Or
that's a nice point. Yeah. So why people do choose to still come to you instead of doing things on their own? I mean, I of course know the answer. There are many.
I think everybody knows the answer, right? Everyone has different values. Everyone values their time differently. Some people don't want to do it. Some people think they'll end up better off. Some people they're not competent with making these kinds of decisions. Life is messy. Let's go back to the basics. Life is messy. Stuff happens. People get sick, they die, they get divorced, all kinds of things happen, right? Number one. Number two, our markets happen. We get extreme events. Extreme events are always connected to stories about how bad things are going to be. This can cause you to really misbehave and not capture the returns that are there for the taking in the markets. Very few people earn the returns of the markets. And that comes largely due to behavior, right?
Yeah.
So, and money flows through everything. So much of our lives are money decisions, because really what you're doing is when you're saving, if you have a lifetime of income, right? Saving is really reducing your consumption today for consumption in the future. So you're pushing money ahead to the future, right? And humans are I think, the only species on Earth that can actually travel through time. So we can imagine ourselves in the future. We remember our lives in the past. So we're always time traveling, right? And it's how you make decisions as you time travel in this world of consumerism, and how do you make decisions of how you spend, but save to make sure you're fine for the future. And in a messy life, that's not an easy thing to do, let alone understand all the tax rules, all the planning rules, all the investment products. And we're absolutely buried these days in information about investing. I would say more so than ever in all kinds of different platforms. So there's no shortage of information. And I would argue that's leaving us as a society more financially illiterate, because there's so many more options, so many more compelling people.
This is very
spoon-fed to us, right? That shows up on our phone and our feed and it's littered with all kinds of financial advice by very compelling people.
This is like a topic that would probably take 10 hours to explore, because you also know that there are many kinds of people that try to give you financial advice, that there are like an entire spectrum from. I find myself, when I want to learn something new, I go to internet and then I find too many sources, and sometimes I just want to get somebody who's more in the field to say, hey, where should I start from? But actually, probably the mistake we all made that we are not in the financial industry is that financial advisors are just there for helping me with the asset allocation, which is probably just a minor part of what do you actually do.
Absolutely. Very small part.
There is a question from the audience, which I think it's very pertinent. It's very timely, and it's from De Peru, that says, did you have any problem convincing clients, that most of industry do things differently? Like, hey, but the other advisor told me that they can beat the market. Why you don't promise that?
Yeah, we've long given up trying to change people's minds. It's very, very hard to change people's minds. And a lot of people confuse the decision process with the outcome, because, of course, in a market this big, there's always going to be great performing active managers, without a doubt. They're always held up. Well, you didn't beat them. Well, of course, just random chance.
Yeah.
You're going to have people that outperform. So again, that makes things very, very noisy. But if you actually systematically stand back and look at the evidence, and as you know, we've interviewed dozens, if not probably over 100 academics in this space, and you know the amount of time that Ben and I put into this. But if you boil it all down to real simple concepts, the basic belief is markets work. I'm not saying they're perfect. I'm not saying prices are right. But when you have this much competition by this many smart people around the world with endless budgets for technology and research, you got to think that collectively they're pretty smart, right? Well, they're setting the prices every day, right? They set the prices. And as someone who accepts that markets work, call it indexing, call it factor investing, call it whatever you want, some sort of efficient market framework, you're basically accepting those prices, with assuming those prices are trading with a reasonable expected is the key, expected return going forward. Because everyone that's making those trades, and think of all those trades every day, there's a buyer and a seller, and they're probably pretty smart. And with the rise of indexing, I would argue the smarter ones are surviving. So arguably, the people that are left as active managers are getting smarter and smarter and smarter. To their credit, they're brilliant. They're doing great work. Many of them will outperform. A lot of those ones that do outperform, like the so-called great managers, are hard to get access to for a bunch of different reasons. Right?
Very good point. Jim Simons is not open for you. Just
that's the.
They're not
you
waiting.
And I would invest in Rentec all day long. You can't get in.
Sure. Sure.
Right? Cliff Asness told us that. Cliff of AQR told us that when he was on the podcast. I would put money there all day long. Also, you can't get in. But the point being is that those are the people that are trading and picking up that arbitrage, the returns, right? But all those trades are happening with an expected return on them. So as someone who believes that markets work, or at least work well enough to meet the goals that us as individual investors and our clients, going back to the plan, what kind of return do you need? How much risk do you want to take on? How much risk can you live with? So too often people just want to beat the market. Okay, that's great. But what return do you need? Are you saving enough money? For many people, if you just save a bit more, I mean, this is a great quote I read in, we're interviewing Nicholas Berube in a couple of weeks for the podcast. He had a quote from Jerry Seinfeld. And the quote was, people keep telling me my money should work harder. And he says, nah, I want to do the hard work. I prefer my money to relax. Suggesting to me that he wants a more conservative portfolio, bonds or term deposits or something. I'm only inferring that from the comment.
Sure.
But again, that's that person's preference, right? So people are different, right? People react differently when markets go up and down. That's why it's a very personal decision, but it's got to be anchored in the plan. Otherwise, like, you're just investing to beat the market.
Mm-hmm. What's your benchmark exactly like this? Yeah.
What do you need?
I've been reading, like, in public recently, a couple of articles from Meb Faber. I don't know if you know him.
Sure, no Meb.
And he has like a few. I think they're great articles. They should be. I mean, I don't care much about the advices inside, but I care about the philosophy. So the portfolio to get rich is different from the one for staying rich, and people care at different things based on where they are on their life path, on their financial path. So somebody which acquired like a generational wealth that can survive 3 generations, they are more preoccupied of not losing money instead of like beating the market. So it's really different. Probably, I think you as a PWS Capital, you handle like wealthy customers, probably not people with like $10,000, I assume. So they might have different objectives, of course.
Yeah, so our median client is in the hundreds of thousands of dollars. Our average client is well over $1 million. So we have some very large clients.
Yeah, great.
But again, if you believe markets work, just that principle, markets work, and that battle is going on every day between buyers and sellers. And think of it at the company level, the battle going on at companies competing for business, competing for capital, competing to raise money. Like, there's so much competition. You got to think at some level this is working. And the markets have largely delivered good returns over long periods of time. And most people don't get what the market has to offer. It's the so-called behavior gap that Carl Richards talks about.
I've heard Ben talking a lot about this in his like channel, or also in the Moniscope podcast, and sometimes in the Rational Reminder, of the gap between investment return and investor return. I hope you will devote a podcast episode to this like issue, to this topic. I would love to know more, because it's also the sometimes people say, oh, if you invested 100 euros in NVIDIA 5 years ago, yeah, but what are the odds that I would get like 80 times my return? I would probably just have sold that 2x, 5x, or it's really, and the gap gets wider the more volatile is the underlying, is the asset class, is the asset. Yeah, that's why I recently heard Ben saying that, yes, dividend are irrational, but the gap is thinner between investor return for people who follow like a dividend strategy. So
absolutely,
that's a nice topic. I would love to hear more data from the Rational Reminder podcast and community. Anyway,
the dividend one is so interesting because dividends do drive better behavior. People love dividends.
Yeah, so, which means in the end, if the best strategy is the one that you can stick with, and that Okay, yeah, that's a nice, interesting exploration.
It's classic Morgan Housel.
Yeah, I haven't even ordered the new book. I should.
It's fantastic. He's fantastic.
I haven't watched later. I still need to listen to your episode with Morgan Housel. Anyway, so what's your role in PWR Capital these days? You are executive chairman, then portfolio manager, CIM, FMA, FCSI. Can you tell us about what are those symbols, those acronyms?
So those are designations in the securities business in Canada. I was in general, I'd say they're kind of old fashioned now. Well, CIM is not. CIM is a designation in Canada. You need to do discretionary portfolio management. So I've had that for decades. The FMA is the securities industries financial planning designation. It's still recognized, but they're no longer being given out. CFP, the Certified Financial Planner, has become the standard. So
okay, I know the CFP.
Advisors have the CFP, and the FCSI is your fellow of the Canadian Securities Institute.
Okay.
I mean, I think it's basically you do enough courses and you apply. They let you into this fellowship, but it's not like having a CFA or CFP.
Okay.
So those are the more modern, very high quality designations that many of our team, like we have many CFAs. All of our advisors have CFPs. So we have incredibly talented bench. So most of my time is spent on, I'm largely out of the day-to-day operational side of the business. It's more strategy, board, thinking about the direction of the company, thinking about, specific strategic initiatives, networking. I spend a lot of time networking with peers of myself in the industry. We have a great community. So I spend
other advisors, other
advisory firms. I spent a lot of time, traveling. I was in New York a couple of weeks ago to meet someone that's has a role like mine in the US. We try to exchange best practices. Spend time thinking about how do you grow? Do you grow organically? So building out our social media platform. Do you do it inorganically by trying to attract other advisors to join you? Well, if you do that, how do you attract it? How do you structure it? Is it what kind of deal could it be, right? So those things take a lot of time. And then, of course, the podcast is an enormous amount of time. Probably.
Yeah, we'll explore the podcast.
So that's where I spend my time. And a lot of time just talking to the team. I just love working with various people on the team on different initiatives.
Did you meet in New York the Barry Riddles or Josh Brown or?
This trip, no, but I know that group, and I know Barry and Nick Majuli pretty well.
I love them. I also like you and Riddles Wealth Management. They are like you are like my main podcast and main source of information from the North America, I would say.
They're communication experts. Those guys, they are just killing it. I'm a big fan. They're good.
Actually, you told me that the Rational Reminder was born after you were avid consumers of the Animal Spirit podcast, and then you decided to do your own version.
Wow. Ben and I said,
yeah, that's good there.
That's two guys talking. They're two guys. We can talk. We had no idea what we were doing. We just started recording. And there you go. That's how it started almost 6 years ago.
6 years ago. Okay. So we're talking about the Rational Reminder podcast. Let's go there. Then we will move back to the financial advisory industry because I have many more questions to ask. But since we are talking about the Rational Reminder podcast, I would start with a question from the audience, which is from Maurizio Barenzano, which is also a dear friend of mine. Question: are you planning to invite Bill Perkins, Die with Zero, to the podcast? I saw you invited Dan Harris. Very, very interesting. Both talk about the life decisions.
I believe he's on the list for potential guests. We're booked up for most of this year. In fact, we if you're a regular listener, we've had a real glut of incredible guests so far this year. So we've actually missed some of Ben's, every other week deep dives. So I'd love to. It's great.
I must admit that I also love the deep dives. So I wish to I wish you will do more.
Ben, yes, we just had so many great guests come up that Ben said, okay, let's get these guests through. Like they've been incredible, and we have more guests coming up. We're booked, I think, right through the fall.
Through the fall. So I was actually lucky that I got a spot like a month after we scheduled it. So you are way more busier now with the podcast.
Yeah, it's pretty busy, but it's pretty incredible, right? Like quality of these guests, like Mayor Statman's got a book coming out. Scott Galloway, if people listen to Prof G, we got Prof G coming up.
Okay.
Dan Harris was a phenomenal guest. Abby Sussman's coming on. Adam Alter's coming on, the Anatomy of a Breakthrough author, phenomenal. We had Todd Rogers came out today, writing for busy readers, which was just, and to take a science approach to that. So we have these incredible, and I'm missing some. I apologize, but there's just been so many great people. You want to get in front of our audience, so we've been doing that. But I agree, we need more of Ben's deep dives. They're so good.
Well, probably I imagine Ben is also like split because I think he's getting more responsibility in PWL, so more other podcasts. So yeah, it's probably hard to do everything. I know how it works.
His other podcast is no joke. The Money Scope. I mean, I think him and the doctor are doing such a great job. I mean, it's truly as a financial literacy course that is largely evergreen, and it's not. Many episodes are not Canadian centric at all.
Yeah, I must admit that I'm a bit behind on that. About the rational reminder, do you do everything alone, or do you get some help?
Well, we get help on the production, of course. We use the same producers as Animal Spirits does, and Patrick O'Shaughnessy. We share the same production team as them because that's all a post pod. But all the up to the point of being recorded, it's all Ben and myself.
Okay, so you decide which are the guests, you contact them, you invite them, you decide how the question list. Like
we find the guest. Barry Ritholtz is a good example. So I knew Scott Galloway has his new book coming out, and I listened to Scott Galloway's podcast, and he mentioned that he's friends with Barry Ritholtz. So I reached out to Barry and said, can you help me get in front of, I'd already tried to reach Scott, but Barry made an introduction to the producer. So there's an example of, you got to be aware of the horizon and what's going on to try to make those connections. Same thing with Dan Harris. As you know, Professor Hal Hirschfield is a very good friend of ours. He's been on 3 times now. He was on Dan Harris's podcast, and I listened to it because I listen to Dan regularly. So I reached out to Hal and said, can you make an introduction? So it's these connections that you have to cultivate to get a chance to pitch to get these guests on. And sometimes they say yes, often they say no. It's a game of numbers, right? So
is there some no that you are, I don't know, sorry about? Say, I really wanted to, but maybe it's not even nice to say. Or if there is some.
Well, one that was recent that hopefully we'll get on one day. I'd love to welcome on Richard Thaler. I'm a huge fan of his work. But we had his co-author of many books, Professor Cass Sunstein. He said yes. So and I don't blame Professor Thaler. Sure, he has lots of requests. He's a phenomenal person. I've listened to many of his podcasts, so I don't mean any ill will at all. But it just shows you, like, that didn't work out, but Cass Sunstein did, and Cass was fantastic. I mean, the man's a legend, right? So it's just the way it goes. But it's part of the fun, right? It's so much fun. Like Dan Harris was so much fun to try to get on, and it's a perfect example of something that's not financial, but if you listen to it, you realize we're all trying to help people's well-being here, and that's what his message. It's about well-being. And if you listen to the interview, he talked about how having a financial advisor is really wonderful to have someone that you can worry about your finances with. So we try to tie it into financial decision making, and some listeners, they prefer, I think, more frequent deep dives from Ben. we call it kind of nerding out and stuff, which we love too as well. We're trying to broaden it because these are things, especially for me, that are really interesting to me, but Ben as well, right? Ben appreciates the lesser technical, non-academic, but still great value add kind of information.
I remember at one point you had like a few episodes where you a bit moved into the field of like happiness and life satisfaction at one point. So it's a topic that you sometimes come back to because it's all connected, no? You want to better handle your finances in order to have a better life.
Well, look at the conversation we had with you on designing your life. It was wonderful. You blew me out of the water. Like you elevated that book so beautifully.
Thank you. I mean, I still don't know how did I end up on the podcast, but I imagine myself like the episode right after with the authors of the book, and then me like getting very small. So apart from me, which I and people like Eugene Fama, Robert Merton, Barton Malkiel, do you have like your personal favorite episodes, the one where you learn the most?
I've learned the most. So, I mean, those three are legends, of course, right? We've had legends on, which has been incredible. Like to spend, I think, almost 2 hours with Professor Fama, 61 questions, and he was a delight, a total delight. And I've had the good fortune to meet him. He would know me. I'm not overstating this, but I've met him and heard him speak many times. And I've immense respect. You think about it. He's been studying capital markets since before I was born. And I'm almost 58. And he works every day of the year. So, of course, the legends are awesome. Just it's so impressive and so articulate. But some of the things that had a big impact, like I think it was Ralph Keeney on goal setting. And that really, like Ben was so taken by that, he went and built this goal setting exercise. The whole notion of, if I ask you once, Giorgio, give me your goals. Okay, park them. Now go and improve on them on your own. Okay, you'll improve them. You'll get a better list of goals. Okay, now if I show you a list of 20, 50, 100 goals, you'll go through that list and say, oh, now you've improved it again. Well, he taught us all about that. That had a huge impact. We had...
you ever end up doing like this exercise for yourself?
Oh, absolutely. Oh, it's fascinating. So we did a big goals exercise. Ben did it, again, to his credit, with, I forget the numbers, but it was a material number of people submitted their goals. And he spent a lot of time boiling them down to get down to, I think it was 50 or so financial goals to help people make better financial decisions. Because if I just ask you randomly, what are your goals? Like,
it's complicated.
Educate my kids, give to charity, but it's not as well thought through, and you haven't thought of all the options. So that was one. Chris Hadfield, the famous Canadian astronaut.
Oh, right. Wait. Yeah, right. I was like just staring randomly to his book. Oh, wow. Yeah. I remember him. I loved him. Like even before he was on your podcast, I used to watch all his videos on YouTube about life on the ISS. That was like incredible.
But I mean, and that was not a very popular episode up front because people saw astronaut not interested. So it was one of our low initial downloads.
Okay.
And it picked up after we kind of talked it up a little bit. But the big takeaway, big takeaway there is, we talked about what's it like being an astronaut. And he said, the joy is in becoming an astronaut. You have to enjoy that journey. So you have to enjoy becoming. It's not being, it's not arriving that you're an astronaut. No, it's about all those years of absolute ruthless dedication he did, but you have to enjoy that.
I remember he usually said that he would stop this career once he had like 3 consecutive days that he didn't want to go to work, but it never happened. I remember this probably coming out of his mouth.
But there's been so many incredible guests, like Anna Maria Lusardi on financial literacy. Ludovic Philippou on private equity was phenomenal. Like to get access to these people. Eyelet Fishback on goal setting. It goes on and on, right? There's just been so many. I'm going to leave people out.
It seems you are more interested to non-financial guests, which makes sense. Maybe in your point in time in your life, probably.
Yes. Ben said that to me because we interviewed yesterday, and this was a totally personally self-indulgent interview. We interviewed Randall Stutman, who is the founder of the Admired Leadership Institute.
Okay.
I don't know if you've heard of Randall or not. I am a raving fan of
it's a name that
he represents. He was on Shane Parrish's podcast and
sure. The book about the he wrote a book. It's the same person. The book about how's it called? The I don't remember the movement. The movement of.
I could look it up. I don't remember.
Yeah, sure. Sorry. I think I remember the name because it's about the effective altruism, something like this.
No, that's not it.
No, okay. I it's wrong.
No, he founded the Admired Leadership Institute. Like I'm
okay.
I find how to build an organization, to build a team, to deliver something special. That is very fascinating to me. So we got Randall Stutman to come on, and Ben said at the end of that, he said, "You love this stuff, this less financial." So I have been moving to that direction. So we might be kind of shifting the podcast streams a little bit. I still do love the financial side. But I honestly, Ben is so good that I feel like I don't add as much value, although I think there is value in having a lay person, a less technical person try to explain some of these concepts. But Ben he's the real deal. He's the gold standard, in my opinion, in communicating these ideas.
I think you are great at letting people believe that they are great. What I'm getting to know you a bit better is that you are amazing at at helping people understanding how good they are. So you're probably
if I have a superpower, and I've never stated this before, but I have no desire to be the smartest person in the room. None. Like, I love delegating. I love empowering people. I just love it. Like, and I have a very young.
I should learn from you.
Our team is very young. Our average age of our team is mid-30s. I'm mid-50s. And it used to be in our industry a common belief that you can't have people more than 10 years younger than you see in clients. Some of our best advisors, all of our advisors are phenomenal. We have phenomenal advisors that are more than 30 years younger than me, and they're handling some of our largest clients.
Okay.
So I don't buy this age thing at all. If you get the right people, the right motivation, and the right opportunity to experiment, to try things, to learn, to develop. And I mean, Ben's a perfect example. Like, who he is now is not who he was when he arrived here.
I want to know more. I want to know more about this. So how did Ben get like did you hire him?
Yes.
Okay. Perfect decision.
It wasn't obvious at the time. None of us are. Who we were 10 and 20 years ago is not who we are today. And this is something he said yesterday. He said, I love looking back. I think he said, I love looking back and being embarrassed at who I was, because it means you improved and learned a lot. It's like, wow, that's really profound.
Yeah, I find I have this feeling like every other year. So I think either I'm improving like at an exponential rate, or I'm still dumb, and there's no way out of it.
And we met a couple times while he was doing his MBA here in Ottawa. And during his MBA, he was being mentored by a competitor of ours. So he joined them upon graduating out of loyalty, and we stayed in touch. And then he participated in an article, like Ask Your Advisor or something like this, in Canada's national newspaper, the Globe and Mail. And he didn't know very much, so he responded in this article that he would recommend this active mutual fund from Fidelity. He got absolutely blasted in the comments in the article. Like, you would not believe it. So he's like, whoa. Like, and he did not, that's not what you want to hear. And he was brand new in the industry, right?
Okay.
And so it caused him to go back to say, well, how should we be investing? And then through his exploration, he ended up getting introduced to me, and we were looking to hire because I put the word out through my networking that we wanted to hire. So we just happened to meet again, and I convinced him, I guess mutually convinced each other to let's come together. Now we were much, much, much smaller than we are today. He would have been on our team, employee, I don't know,
10.
Oh, not even 10.
Okay.
5,
Oh, wow.
5,
Okay.
6, something like that.
Okay.
And we just started working together. And then as we got bigger, we started, 6 years ago, probably 7 years ago with his YouTube, to start this content forward strategy. And he decided to start doing YouTube.
So you decided as a company to have like a face on the internet, on YouTube.
That was the word. Let's build content. People looking for content.
Okay.
We're really just trying stuff. It was a grand experiment. So we just tried that, and then we listened to Animal Spirits. That's what kind of got us doing the podcast. But there was no deliberate strategy. It was just put it out.
Okay.
Put out the content to the world and see what happens. And then he was doing his videos, and he got better and better and better. And it's that commitment to that continual practice and improvement and open to experimentation. And there's no master plan. And if I was the leader, I realize I'm not trying to be smart about this, but it's like, try it. I don't know what it's going to be like. It could fail. So what? We've been doing all kinds of things for years that failed. We've done radio advertising. We've done call-in shows. We've done magazine ads. We've done lots of different things that you never know what's going to work in marketing. You have no idea.
So the success of your podcast and Ben's channel, like, contributed a lot to the growth of the company.
It contributed to the growth. It is one of our top generators of meeting new people to this day. But the real benefit is all the unintended consequences that came from it. And that's what's really incredible. That we never, ever imagined that would happen. Number one being meeting great talent. Because this happened concurrent to us having really dramatic growth. Like, we grew, 20-fold over 5 years.
Wow.
So we hired in 1 year, we hired 25 people in 2021, I think. That's a lot of people. The vast majority came through the podcast because people would hear us, they get to know us, right? As you know, as people build some sort of electronic relationship with you, this auditory, like the power of the voice is so strong, and you either like the voice or you don't. Like, people listening now either like me or they don't. And that's how the world works, right? But they would hear the message, they would hear the people week after week, and people started following us and reaching out and saying, I want to be part of this. So we end up with this pool of motivated, smart, talented, driven people on our team. So you combine that and combine that with my lack of any desire to be the smartest in the room. Okay, let's just figure this out together. We're smart people. It's fun solving problems. We know Canada, you talk about Italy, but we know Canada needs us. And that's
why don't, so you're saying that things are still not very strategically well defined in the content creation, like, division of your business. Why don't you, I saw that the Compound, the day they are like, they have a media business right now.
Yes.
Given the amazing results you had so far, why don't you structure it?
Oh, it's well defined now. I'm saying at the beginning.
Okay.
It's much more defined now. We're much more deliberate now on what we're doing. And then that's only going to evolve. We're redoing our web presence now. We plan on repackaging much of the content into micro content, for different platforms. We're planning, improving our SEO game dramatically. So, Angelica, our lead of marketing. So we have great aspirations for that. Mark McGrath joined us, a phenomenal advisor who has tremendous presence on Twitter. So we're quite deliberate about this, and our business, 60% of the people we're meeting now are coming from website, Twitter, Ben's YouTube, and the podcast. So those are 4 channels that are very uncommon in our business. Red Holtz, absolutely. I agree with you. I think they're as much a media company as an investment company.
Okay, yeah. Of course, the risk is to tilt too much in that direction, of course. There is also the Rational Reminder community, which I totally recommend. And I think it's the main online forum, how do we want to call it, for Canadian, and not only. There is a lot of even European threads. So Rational Reminder community, you Google for it and then you can join. It's free for now. It's free for now.
It is free. Yeah,
it is free.
Yeah.
How did Ben end up on YouTube? It was his decision, or
it happened right after.
His channel is pretty successful, even though he's not publishing that many videos anymore. But
it came. Angelica joined and said, "We have to create more content. Ben, you should do videos." It was not more strategic, I don't think, than that. And he got the screen and got the microphone and the camera. We started experimenting with different things, and then I think, I'm not sure which video really kind of went viral, but I know I
think the top one is still the 5% rule on renting versus buying.
I think that's the one. That one has been very popular, is often mentioned. So
okay, I love the series on cryptos. I must admit, when you decide to spin off a bit and take a single topic and go deep dive in that topic, and do you plan to do this for other mini series on some specific topic? Because that was very structured, and I actually loved it. I loved it how you brought people which were totally against, people who were possibilists, and people who were very pro, and so you let people get a huge spectrum of opinions on the topic.
It was a genuine learning endeavor. And I thought I said this to Ben at the time, I said, you look back and this is one of your, I think, proudest moments, because it's classic Ben. Go in completely open-minded, right? Do a deep dive and do your best at explaining it. So there's that combination of research, open-mindedness, and communication that is what made it. And it was deep, as you know. Some of those episodes were very deep, and some were very technical. But it's important to have done that, I would argue. So will there be other series like that? Possibly, but what we're thinking about now is different kind of themes. We might have Rational Reminder, well-being type episodes, Rational Reminder deep dive. So it'll still be in that Rational Reminder thread. But if you only want the Ben deep dives, you'll be able to. It'll signify that if you're okay with Cameron's different stuff, that may be identified as well. So that's what we're kind of kicking around right now.
I can recommend you to use playlists. That might be something that so people want to go on your channel and say, oh, there is a playlist on behavioral finance, a playlist on the basics, or.
Well, that's the other thing we're thinking too, is because we got behavioral finance goes in so many different episodes. Is there a way to?
Of course, it's
where AI might take this. Who knows?
Oh, that's an amazing idea for a new subtopic. Yeah.
Can you imagine your own customized playlist based on your preference?
Well, there is already, if you go on YouTube, there is for you the section that you're gonna channel. But
and I'm saying, can you imagine saying I want all the clips that are behavioral finance and just assemble them all and have AI pull it from all the different episodes? That would be cool.
Okay, I'll tell to my friends at YouTube. I used to work for YouTube in Google, so
really?
To switch back to portfolio management and financial advisory. to this date, what's your opinion on crypto? This was not planned as a question, so it just comes from the audience.
What's my opinion on crypto? The takeaway I took away from all the deep dive that Ben did. First of all, I'm not an expert on crypto. This is just an opinion. It might be worth about a nickel, so take it for what it's worth. But the essence of crypto, as I understand it, is about shifting of trust. Now, where should trust go? Right? And I don't know that crypto represents the right answer for a currency. My gut is no. That is not a comment on performance. That's not a comment at all. I realize what's happening with the spot Bitcoin ETFs. It's been, in hindsight, should not have surprised any of us, because for sure there's going to be retail demand for this.
Yeah.
Without a doubt. So a lot of this is, I believe, demand-driven speculation, which is often tilted towards younger males as a research. And we've talked about that a lot on the podcast. I'm just not a fan of monetary policy shifting money to a platform like this. Like, who are you going to call when you lose your password or your, like, it's just there's so many impracticalities about it. I realize that's not a great answer, but that's the best I got for you.
Okay, we'll make it suffice. I gotta take another audience question. Somebody actually offered us €2. Thank you, Damiano. Cameron, your view on quant hedge fund?
So you're talking about like the Renaissance Technologies kind of quant, or AQR quant?
I think it's quantitative. Yeah.
I mean, I'm a fan of quantitative, which is rules, my interpretation, rules-based investing. So we've spent considerable time studying factors over the years. I'm a believer in factors. I don't believe that all securities should have the same expected return. I'm not saying realized return. I'm saying expected return. So if you believe that there should be different expected returns in securities, there must be some characteristic about those subsets of securities that drive why that would have a different expected return. So many quant funds go to exploit those differences in expected returns. For example, if you believe that value should outperform growth, you might have a quant hedge fund that goes, long value, short growth, for example. So those are kinds of things, for example, that AQR does in simple terms. So you could do that, then install leverage in that to magnify those differences. So not a fan of leverage necessarily for the average retail person. I get how mathematically it should have a good outcome. I appreciate that. But when you're talking to normal people with their normal retirement savings, it's hard enough to invest without leverage. And yes, you can run all the models you want. Leverage makes sense until it doesn't. And then what do you do in 2001, right? 2008, 9/11.
How much leverage? But of course, yes.
March of 2020, right? You wipe out a lot of capital very quickly. Yes, it rebounded, but did you hold through that?
So it amplifies the odds that you will not match your investment return because you might behave badly.
But if you take Rentech, Renaissance Technologies, their main fund, I mean, as we said earlier, phenomenal, brilliant. Jim Simons and his team, brilliant. We would all invest in that all day long. But if we all could invest in it, it would be way too large. And you got to believe the returns. I think they said this would mean revert. It's very hard to optimize. That's why they keep it capped at, I think, 10 billion, right? And they flush out all the profits every year back to the employees. But rules-based, I love rules-based. It eliminates a lot of the behavioral biases. I love the like we said earlier, the power of dividends to cause good behavior, the power of factors to me around my framework of viewing the world. And a lot of this comes from Professor Sfalma, French, that I believe in differences in expected returns. However, once you have that belief, you really have to believe it when you go through periods like we have now, where growth stocks outperform value stocks, large outperforms small. This is historically not normal.
That's why I have problems with factor, because I'm also my portfolio is factor tilted. Like almost following some of your model portfolios. Not exactly your model portfolio, but I'm following the philosophy. But I've recently read a paper by Manuel de Prado, which it's a meta-analysis on how factors are not that scientific. So there is not enough data. It's more alchemy than science. The methods that they are tested, that there's no special attention to causality, but just correlation. And that's why everybody's trying to find new factors. And there's already 100 different factors from different studies. And it looks like, not sciencey enough.
That's the drive for academics to get published, right? So that's the so-called factor zoo. I think there's over 400 factors. But the simplest factor to me is the value one. Most of it comes down to price. It's some ratio of some fundamental of the company to price, be it dividends, profit, whatever. Price is the determinant. So the
price to earning ratio. Yeah.
Whatever it's all ratioed to price in very simple terms. So again, to make it simple, if the price goes down of a stock, it's going down for some reason. Now, is it behavioral, like Richard Thaler would say? Is it risk, which is what Professor Fahm would argue? There's a story there. No one knows what's true, because don't forget, these are all just models. Models, by definition, are not reality, right? It's just a model. So if a price is lower, and if you believe that not all stocks have the same return, well, if all stocks don't have the same return, something that's cheaper relative to a fundamental should have a higher expected return, because the people that are trading all day are pushing that price down for some reason. I'm willing to take this stock off your hands, Giorgio, at a certain price because I have a need for a higher expected return. Is it risk or is it behavior? Honestly, I don't care. I'm more comfortable with the risk story. I'm not saying I'm right, but to me, it makes sense. Price goes down, it's riskier. But I don't want to make a bet on just one stock. I want to own all the ones.
Sure.
That's the whole point of having a factor. So that would make sense to me. I'm not about
it explains the extra return of Warren Buffett almost matches exactly. But it's a reality that in the last 15 years is underperforming. So it's also,
but again,
you gotta be a real believer to still.
But it's no different than the market factor. Who said the market factor has to have a positive return?
That's a good point.
You can go 15 years. In fact, Ben has a paper that shows
that's a good point.
The market factor has less reliability than the value factor. So if you're really going to
your first episode with Scott Sederberg was about this, actually. The episode 224 with Scott Sederberg, that actually he loves to destroy common belief. And I think it was episode 224, and he actually brought on the table the fact that maybe you can have period of 30 years, 13% of 30 years period in real terms, stocks underperform, you lose money.
Yeah.
So which means market factor is also not guaranteed.
But how can it not be that? It's risk.
Sure.
It's risk. Right?
It's loss aversion. You are betting that the price is set to the point where people are willing to accept that risk.
And look at it now. So many investors in the market, so many people getting exposure to capital markets, largely mirrors my career going back to the early 90s. That's when participation in the markets, I think, really accelerated. Especially, I can speak for North America. The participation rates are much, much higher. So therefore, indices had great returns over that period. A lot of investors have not. A lot have had good returns. But this whole, I deserve to get this return, it's quasi guarantee of the markets, no one should believe that. It's all about expected returns. Nothing's guaranteed.
Actually, I recently watched a TED Talk by Professor Robert Gordon, which was probably 2010. and he explained how, in his vision, I mean, I like to see also like position contrarian to my belief, try to challenge my belief, and there is somebody who thinks that maybe we are used to 150 years of exponential growth at this rate, but actually we consumed a lot of potential growth, and that is maybe the future is not like the past. Because we all invest in the belief that the market will go up X% per year. But do you have any opinion on the very long term? Is the infinite growth, like exponential growth, in your opinion, continuing forever, increasing, decreasing? That's a very philosophical question, of course.
It is a very philosophical question. So over long periods of time, markets have had returns and the real returns in the 5% range. Is that a reasonable expectation for taking on that amount of risk? Seems reasonable. Now, a lot of people have much higher expectations, but that's the kind of number that Gene Fama told us about, right? That's a reasonable return, real return, I would say. But you can have periods where, like Morningstar had a piece come out today that Larry Swedroe wrote, countering Scott Cederberg's research. But the point of Cederberg's research is that you go back in the 1700s to like the mid 1900s, stocks and bonds did about the same. Yes, markets are different, information is different. I get all that. And then from the 40s to the 80s, stocks did really well. 80s to now, bonds did really well too. There's not a lot of difference because interest rates fell, bonds did very well. So there's no real guarantee, right? But for people to say, oh, I'm going to get 10, 12, 14% in equities, like, well, everyone clearly can't make that. I would argue that seems like a very high cost of capital for companies, right?
Makes sense.
So for that to happen, if we're going to a certain price in the future, that would mean a serious discounting of prices today. Again, that's the value factor, right?
And reversion to the mean. Anyway, sorry, we are jumping from a topic, but that's how live interviews work. Coming back to PWL Capital, so how does your service work actually? So you have customers, and how do you get compensated? What's your business model?
So our business model is assets under management percentage based, and it's scaled. So it starts at a higher number, it goes down to a smaller number on the next dollar.
Are those numbers public or?
For sure. We're quite.
I think I didn't find on your website, but
we're transparent. What's on the new? Our website is being rebuilt, so it starts at 1.25%.
Okay.
For what? And that's what we get paid. We don't get paid by any product provider. And then it starts decreasing once you get over $500,000. So it starts going down. Then once you get over $1 million, it starts going down quite quickly.
Okay. So that's for very wealthy people, what's the asymptotic value?
Our average fee is in the 0.8, 0.75% range, which in our industry for full service, because we of course benchmark, we're aware of what the market's at. That's normal, maybe a pinch below. That's because I think compared to the average firm, we have more larger clients. That may or may not be true, but that's my belief. So we're in the very fair fee. And what's happening, a trend in the industry is the industry's been adept at keeping the same fee, but adding more and more services and more quality people. So that's the dynamic that's been happening for many firms in our space. We don't do any product manufacturing, so there's no extra revenue captured by product. So we mainly invest with a company called Dimensional Fund Advisors.
Yeah, I saw all your model portfolios are like contains products from this company. So there is no conflict of interest. You don't get paid by Dimensional.
No, we can't do that.
Okay.
No. I mean, I have this tumbler
Okay,
They gave me that.
Wouldn't count as a bribery.
They gave us that as at a conference, but we pay to go to the conference. We pay for the hotels. I think they can buy us lunch.
Okay,
So there's no soft dollars.
so there is like a very harsh regulation. If you get like a hotel for free, you might be in conflict of interest now.
You can't do it. Can't do it at all. So yeah, we've worked with them for 20 years now since they've been in Canada. They're, I would argue, a very high quality firm. The founders of Dimensional actually started the first index fund, so their roots are in the index fund world. However, the basic belief is that there's ways to improve upon an index, because let's face it, once you understand indexing, they're really not as passive. And passive is such a loaded word that we try to avoid that word.
Interesting.
But it's really improving on indices and understanding the sources of returns. So the portfolios are built around the sources of returns. Average expense ratios in Canada are in the 0.35% range. These are for globally diversified, factor tilted portfolios, including small cap factor. So it's, of course, a little bit more expensive for that, but they have like real time rebalancing of factors, where if you buy a typical small cap index fund, it might only be reconstituted every 6 months or every year.
Yeah.
So you have tracking error there compared to the underlying index, but often the index is not the best representation of the source of that individual source of risk. So that's why Dimensional doesn't benchmark or doesn't use as a source of building portfolios or traditional benchmarks.
Okay. That's amazing. I'm not sure if they're also. I think I saw that on Interactive Brokers. I mean, I think I can access to those funds, but they are not available to Europeans usually. They are not.
You get access to the ETFs because they can't restrict access. In Canada and the US, it's restricted access to the mutual funds. But in the US, more and more
Europe, Switzerland is different, but the rest of Europe, you cannot access to ETF, which are not harmonized by like a European directive. So I don't think there are European approved. I can invest in US assets. I think even in Canada assets, but directly because I'm in Switzerland. But for Italians, for example, they are not accessible. So
I know Dimensional has presence in the UK and Ireland and Germany.
Okay, so maybe. Okay. Oh, there is also Avantis.
Yes.
There's another. Yeah.
Yes. Avantis, and we know Eduardo very well. We know they just broke through $40 billion. They're arguably a copy of Dimensional.
Cameron, can you convince George to drop 2 lightly tilted Vanguard funds in favor of Avantis ETF? I'm considering that. I'm considering that because I'm
that's
not
an easy one. That's a layup, Giorgio. That's a layup.
I will do. I want to move into the more how can I say? What do you think? What do you think financial advisors are very good at and cannot be killed by robo-advisors or do it yourself? Like, because people are saying to me, sometimes I mean, just to give more context to this question, as I said, I'm in a kind of personal fight against like a Italian financial advisor industry because like active fund manager and bank fund sellers, they try to fill your portfolio with crappy products. But there is also like the independent advisor, but there is also like the robo-advisor, or people say, oh, well, if I have enough skills to understand that my bank advisor is proposing me crappy funds, I already have the skills to do it on my own. So just open a brokerage account and invest in diversified low-cost index fund. So do you think you are in competition with robo-advisors and people who are too much educated and go on your own? Or put in another way, if you keep educating people, don't you think you're going to lose your job?
That's a great question. So let's chip away at that. First of all, I am a huge fan for the right people for do-it-yourself.
Good.
If you can do it yourself, you do not need me. By definition, if you can do it yourself, I can't add you value. I can't add value to your life, right? I don't want to try to add value or convince someone to pay me if we're not having meaningful impact. That doesn't make any sense, right? Now, I would argue not a lot of people can do it themselves, right? For sure, all the ingredients are out there. You could listen to many different podcasts and get access to beautiful portfolios. In Canada, for example, Vanguard and BlackRock both have very good, very low cost, pre-built, globally diversified portfolios with all kinds of different assets. They're beautiful.
Life strategy or target date funds, yeah.
Beautiful for 20 basis points. If you can do it on your own, I love it all day long. I don't understand where robo-advisors compete with that. That to me is a harder value prop. And in Canada, our largest robo-advisor has been getting into things like private equity and crypto and trading and whatnot, because they need to create revenue or cross-selling other products, I would think, to justify the massive investment. I think that's a tough game when you're competing against Vanguard for 20 basis points. But I leave it to them to make their value proposition. But the reality is there's a ton of people out there. In our world, doctors and dentists are a perfect example where their structure is complicated. You have corporations, family trusts, income splitting with families. We do a lot of work. Like I have a team of on the advice side of our business, not the operations side, but the advice side. We have a team of 25 people that work every day, all day, answering all kinds of questions, dealing with all kinds of people like accountants and lawyers and insurance people to pull this stuff together, which is really what wealth management is, pulling all these pieces together in a way that helps improve our clients' lives. It's as simple as that, but there's a ton of work, let alone the implementation of the portfolio, tax reporting, tax planning, crystallization of gains for income splitting with family members, setting up sales of loans. It goes on and on and on. And a lot of people
planning or
a lot of people are like, I'm out. I don't want to do it. My time is too valuable, or I can't do it. Like, to assume that people can do it, the evidence shows they can't. And when you look at that behavior gap we talked about, if we can help them avoid that behavior gap, our fee is a fraction of the behavior gap, let alone all the other services. The problem becomes if you start paying. In Canada, the average expense ratio in our world is well above 2%.
For actively managed whatever.
And get this, mutual funds in Canada are subject to what we call a harmonized sales tax.
You mean it means probably at the end of every year you pay capital gain, or
no, you pay the province a percentage of the management fee in sales tax. In many cases, people are paying more to the province of Ontario than what you could have bought that Vanguard fund for. It's no fault of the province. That's just the tax regime we live in.
Okay.
But these numbers get big. You start paying 13% on 2%.
Okay, so you pay extra taxes because you are getting a service from Ontario instead of like Vanguard. Okay, so it's also tax inefficient. Yeah,
tax inefficient. So I think there's an amazing opportunity in this world to deliver great advice with these beautiful low-fee products, given the science that we're all learning about and becoming aware of in today's world. Just finding that right advisor that shares his philosophy, has real discipline, doesn't get caught in the created margin by having in-house product or selling private equity or some other. And I'm not necessarily opposed to private equity, but in many cases, very hard to justify the fee, right? Don't let the fee capture. So that to me is a pretty solid value proposition for the right person. If that's not for you, don't pay. Like if I don't want water, we used to have an ad in Canada. If I wanted water, I would have asked for water.
Yeah, I think this comment summarizes it very well. This is right. This right here is what's currently missing in Italian landscape. The most financial advisors are not intellectually honest. They don't care about adding value. So that's
Most
That's
people,
amazing.
when I say that markets work, you know what I mean. I think our listeners know what I mean. That just believes in the power of the markets, the power of the collective thinking. That statement alone will make most advisors' heads pop off in Canada. My job's to beat the market, Giorgio. I can pick the stocks. I can pick the fund, the alternative asset class. I can pick, right?
But it's a full-time job with no guarantee of success. Actually, you're most guaranteed to have expected that they are negative because you pay more fees. Does your firm, or actually you do with your online mission of like the podcast and the channel, do you try to educate your customers? Are you in the field of like financial education somehow?
Absolutely. Financial literacy globally is abysmal at best. You've seen Professor Lusardi's work on this. 5 questions, which you and I would say are pretty simple. Very few people get all 5
I've
right.
seen a lot of variations. There are many studies on financial literacy which are a bit more in depth than those 5 questions. And there is also like amazing results. The OECD countries, there is like the OECD ENFE, which is like a subdivision of the OECD, which conducts like yearly studies on financial literacy. And I'm actually like devouring them because I want to, I don't know, I think part of my mission is like to bring awareness and help getting rid of financial literacy. But the problem I find is that those who need to be literate, they are not looking for ways to get more literacy. How do you reach the man on the street? How do you reach because those who listen to the Rationally Minded podcast probably don't need a lesson on financial literacy. How can we reach more people?
This is the question that Ben, Angelica, and myself spend more time on than any other. How do you reach the average person? Because you are right. Our podcast is way too nerdy for the average person. The average person would never listen to it. But what we've learned is many people who have influence in others' lives listen. We get a lot of people reaching out to us that say something like, my son-in-law listens to your podcast. I just sold my pig farm. I need to talk to you. That happens fairly often. So that's one way of doing it. The other thing that we're working hard on is, if you heard our interview with Dr. Preet Banerjee, he talked about the painkiller strategy. So if you wake up tonight, you are unlikely to wake up tonight and say, "Oh, I need to start taking vitamins," and to rush out to the pharmacy tonight to get a vitamin.
This can wait.
If you wake up tonight with some massive headache or massive toothache that you can't sleep, you will likely go to a 24-hour pharmacy and take something for that. So we're doing this. We're following what Preet suggested, which is call it a painkiller strategy, because so many people now, my father just died. I inherited $1 million. Who do I see? So they inheritance advisor near me, or I'm getting divorced. What do I do? So they're looking out and they're going to Reddit. They're going to Google. They're going to wherever to find out, in this area of Ottawa that I live in, who can help me with my divorce settlement. That is proving to be very good because there's a lot of people who listen, who talk in Reddit. And now from a strategic standpoint, we plan on spending more time cultivating those common questions and putting into our content to feed back into helping to get the right information to the right people. Because someone might be getting divorced here 2 blocks from my office that may not be terribly literate, but they need legitimate help. Where do they turn? They're likely going to turn to the internet. Probably not their friends, unless they have someone they really trust. That's very different than 30 years ago. 30 years ago, most
go to family member or the bank teller.
Or the bank. I mean, Canada, as you may know, we love our banks. We have, 6 big banks in Canada. Very different than, say, the United States, which has thousands of banks. So it's a very, very different. In Canada, we have a particular affinity for our banks. And the banks, I believe the banks oversee in one of their channels well over 80% of all long-term retirement assets in Canada. We're a bank-dominated industry.
Okay. Do you think it's a good setting, or
It's a great setting for stability. It's a great setting for confidence. Like we don't worry about the safety of our banks. Even going through 2008 was never. I think we all get great service from our banks. We have incredible. I believe, even though we don't have open banking, I think we have great technology platforms, and you just feel safe.
But efficiency-wise,
and I'm always amazed that, I mean, the polite way of saying it is, I'm amazed at the bank's ability to extract such high expense ratios from customers. The trust in banks, and all you have to say to someone who's considering us versus Royal Bank, yeah, but what if it goes wrong? You always know you can sue the Royal Bank. Like, it's the Royal Bank. It's the Royal Bank. So I get that. I understand the confidence in that.
Okay, it looks similar to Italian. To the like also in Italy, people go to bank for this, but it has a different. I don't know.
Do you have an independent advisory culture in Italy?
Not much.
Really?
There are people who there is actually like a legal treatment, so you can get recognized, you can get like a certificate, you can start the profession of independent financial advisor. But I think I don't want to say anything wrong, so I might be mistaken with the number, but I think like out of 20,000 official advisor, only 500 are like independent. The other 19,500 are like not independent. So it's like the vast majority of financial advisors are not independent. And if you are an independent advisor, you need to face a lot of bureaucracy, which part of it is justified, of course, but there is a lot more. And so you need to reach like there is a critical mass if you don't manage, I don't know, at least like 20 million. So asset under management, 10 million, I don't know. There's a minimal amount that it doesn't make it worth unless you ask that 3%, which doesn't make sense. So, and it's also hard to get like advertisement. I think they cannot even advertise much. There is also some rules you cannot do, like, of course, confront, like you cannot do comparative, you cannot, there's like
same here.
How is it called in English, where you cannot do advertisement, like bad advertisement, unfair advertisement. So there are not many. They usually group in consulting in like it's called SCF, Society of like Consulting. But we have Italian postal system. Okay, that's a meme. So there's not many. There are few of them, and I don't know the status, like how healthy is the independent advisory industry. So
do you have a large pension? Do you have a large pension safety net that might render it unnecessary?
Yeah, there is a state pension, but if you look at it's unsustainable. So every year they're pushing like retirement age further and reducing the conversion rate. So people, like if you are below 40 in Italy right now, you know that you won't get much. You will get something, which is probably 40% of your last salary at age 70, which means you need to also care for your own pension. And that's something that's been degrading since 20 years. Like my father, like is now retired since, I don't know, almost 15 years. And he still got like full package. You retire at age 60 and you get like 80% of your last salary forever. It's an annuity perpetuated in eternity. But now things are changing. So people need to take care on their own. That's why a lot of people, also like young people, start planning to invest for the next 40, 50 years and grow a nest egg. Yeah.
So you face a similar challenge that we do, which is getting people to realize what lifestyle makes them happy today, understand what that lifestyle costs, and watch that lifestyle creep. And if you can find out that lifestyle, and as your salary increases, you save more as you get older, which is a very tough sell for many people.
how I think Ben said it several times that probably is sharp, that mentioned that the retirement spending is the nastiest problem of all time. And how do you actually help people in retirement planning? You try to go with a constant dollar spending, like adjusted for inflation, or you model as a curve that goes up and down based on that's a very interesting topic to me.
It's so fascinating because it gets to what really does get to the root of what makes you happy. So we spend a lot of time when people are approaching retirement thinking about what is your baseline need and what is your wants, and how flexible are you on that wanting part? Because we all know if you can vary your spending in retirement over your retirement, you will be able to spend more. It just means it's going to be wavy. So we spent considerable energy and time in building a tool that actually allows you to model variation of spending. So you put in that fixed amount, right? But again, you need to understand what makes you happy. Like, how big a house do you want? How many cars do you want? Like, and all this goes into that, right? So, but it's about thinking about that deliberately, not just hopping on the hedonic treadmill and increasing your lifestyle because we're bombarded with these teasing ads all the time to accumulate stuff, right? So we spend a lot of time helping people think about that. Then once you start modeling it, and the software we've built is super cool on this that our dear colleague Braden built, someone who we met through the podcast. He built this tool so we can actually model this out, and it does real-time Monte Carlo on it, which is very, very cool. And you could taper your income over time, so you want a certain amount up to a certain age.
Oh, wow. Okay. There is an online tool which is probably like a fraction of what your tool is doing. It's called Fire Sim, if I remember correctly. It comes from the FIRE community. It's like Fire Sim, and you can model. Okay, I'm gonna need like a constant amount for this age. Then I want to buy a house by that time, or I want to have a fixed spending because I don't know, my daughter will be 18. I want to give her 50,000. So you can put things, and then it does a Monte Carlo simulation. But probably just using historical data is not actually a Monte Carlo simulation. It's just like trying to replay your plan from 1920 to today, taking all like month by month. You have like a sliding window, so it's not actually Monte Carlo. It's just
the main thing is to install uncertainty into it. So you start thinking about, because this world is not certain.
Exactly. How do you model all the uncertainty? Because you can ask people that maybe they are 40 today, how do you plan your retirement? But then life happens. So there's a lot of variables. In the end, it's always a mess.
It's always a mess. And it's never going to be what you planned on. Never. Yeah. And that's why it's good to have a buffer in there. Yeah. And I would argue, to be conservative. You know, the famous so-called 4% rule. And I know it's been widely attacked and criticized, but there's still utility in that, because a lot of people don't even think about their money in that way. They think about, well, if I can get 5% of my money, I have $1 million, I can spend $50,000 a year. Yeah, but what about that pesky thing called inflation?
Well, the 4% rule actually says that you should like adjust your initial withdrawal by inflation, but
correct.
The problem is the dollar cost spending method. So like you nobody spends the same amount every year.
No. But so many people in retirement don't even isolate what they absolutely need. And what are your housing costs? What's your vehicle cost? Your cell phone, your insurance? What is that number? And let's isolate that to make sure that is covered. And to think about, if that's what you need, but this is what you want, that has a huge impact. Because let's face it, in a bad year in the portfolio, you're not likely going to do your round-the-world cruise. You'll put it off a bit.
Sure. So flexibility and having like a needs versus want. Okay, this is a question that comes out frequently in my recent live streams. After Scott Sederberg episode 284, do you think, Well, what's your take on 100% stocks? And do you think retirees should have like a different portfolio compared to people who are still in accumulation phase?
So I agree with what Scott emphatically said, which is you have to be able to live with your portfolio. He doesn't think 100% equities is pragmatically realistic for most people. Behaviorally, and I've lived through it. You got 100% equity and you're retired and you come into March 2020 and your portfolio is down 30% in 3 weeks.
What's going to do? Coming back to work? Well, if it's in 3 weeks, you can still go back to work probably. If it happens after 2 years, it's
but if you're $2 million, it's now worth $1.4 million.
Yeah,
I know it's on paper, and I know most of it came back by whatever, not that long after. I get it, but at that time, we were staring down the pandemic, right?
There were corpses, like that famous picture in Bergamo in Italy, like with tanks bringing corpses, something that never happened before. So you say, okay, the market lost 35% in 5 weeks. Is it going to mean revert, or this is like a zombie apocalypse?
And this is the problem, is that you can say, oh, I could handle 30% downturn, no problem. Because I see someone's asking
in the past.
Like, I could do that. Sure, you could do that when you're sitting in my office, having a nice cup of coffee or having a pleasant chat in the world. It's a beautiful day outside. But I can tell you right now, in September of 2008 or October 2008, very different. You're staring down the survival of the monetary system.
Yeah.
I was there. I lived it.
I wasn't invested there.
I can tell you, you can tell me in a nice sunny day in Ottawa that you're going to stick to your portfolio when you're staring down, is capitalism, is monetary policy going to survive? Lehman Brothers just failed. You're going to be fine. Like, risk is very different when you're in a nice office, having a pleasant cup of coffee on a nice day than when the world is doing what it was doing. 9/11, right? March of 2000.
Yeah.
Stuff like this happens. So, and Scott talked about that. I mean, Scott's findings were important and very, but theoretical. And he said that. Absolutely said that. And the question I always ask is like, that's looking back, which is great, but what if that's wrong going forward? And what's your affordability to be wrong? What if you're wrong?
Nice.
What if we go through a 20-year period where you look back and say, gosh, never thought that would happen. Stuff happens, and you got to be resilient. You have to be resilient not only with what you have and how you manage it, but how you think about it. Like, and this is something that was so fascinating that Dan Harris talked about on our pod last week. We all think that we've got our own, because we live our lives through our own frame of reference. And we think things are pretty constant. You go home after work, you have dinner, you see your kids, you do it again tomorrow. So but the reality is that we're changing, or the way we think is changing, our spouse is changing, the world is changing, the markets are changing, companies are changing, products are changing. This world is ever evolving, right? So you have to be really resilient in that world. And an interesting piece to attach to that is like Morgan Housel's book, Same as Ever. So even though things change, how things do change, the fact that things do change is always the same. There's always something new and big, some big news story, something that's happening in this crazy world that you didn't think of. Look at what's happened the past 6 months we didn't think of. I don't want to get into the details, but stuff is always happening.
Yeah.
Like you live in the world of technology. Look at this world of technology. What is AI going to do? Like, yeah, you'd hear some chatter about AI, but it blew wide open 14 months ago with ChatGPT. I never imagined, I wouldn't have Google as my default browser on my web, but we're a Microsoft office. Now I use Bing. I never would have thought that would ever be possible.
Okay, I'm not there yet, so but I understand, yeah.
So, but the point is, the more things change, the more they stay the same, but there's always something new. But how you will react with your portfolio when you're relying on your portfolio for your retirement income, to answer the question, what asset allocation would I recommend? Well, let's go back to the plan. What does the plan say you need? Are you more like Jerry Seinfeld, where you want to do the work and let your portfolio rest? Or do you really need the extra returns from your portfolio? And do you have the ability, willingness, and need to take on that level of risk? Everyone's different.
Interesting. So it's very customized. People here want to force you to say something like, hey, so 100% 60-40. I think it's really what I'm learning right now. Like I'm talking with people and it's really personal. I mean, assume you have 100 times your yearly spending. Maybe it's even wise to put money under the mattress. Assuming you are retiring with 10 times your yearly spending, you need to face some risk or else you will run out of money. So it's really personal. There's not a single portfolio.
People get so hung up on optimizing portfolios, but how about you optimize your behavior? How about you optimize your spending? How about you optimize your savings? Once you've optimized all these other things, let's talk about the portfolio. But too many people say, it's a portfolio, you got to optimize the portfolio. Well, if you're young and you don't have a lot, and this is something Nick Majuli talks about, from Ritholtz, wrote the book, Just Keep Buying, phenomenal book. It doesn't really matter what you earn, it's what you save. How much you save is what really matters. Right? But the assumption that it's all in the portfolio, that you've got everything else figured out, not many people I've met have got it all figured out by the time it comes to the portfolio.
Very good point. But the problem is that the portfolio is more objective. So people try to optimize it because it's more objective, while the rest is very subjective. So it's like every people is different. And I probably heard this. I don't remember if it was in the Rational Reminder or in a band's video, the sentence that the way you measure risk now is not volatility, but the ability of a specific plan to meet your future needs. So that's why, it's Ken French. Okay, it's not Ben. And I loved it. So it really, you don't need to be exposed to certain type of risk if your portfolio is like already there. That's an amazing sentence. I didn't know it was from Ken French. Okay.
I don't know if he's the originator of it, but he did say that on our podcast. The risk is not achieving your financial objectives.
So how do you, this is a question from one of my readers, an offline question. I if you still have time, like 15 minutes and then we're done, Cameron.
I got a little time, I'm fine.
I'm gonna grab some questions that from our Reddit users posted on. We posted like, "Hey, I have Cameron Passmore. Do you have any questions?" So the user Fuoco negli occhi asked, "How do you handle extreme or unexpected market events?" By you, I don't know if he meant you as a Cameron Passmore or you for your customers. Like, feel free to explore the question.
I have great belief in humanity and our ability to continue to create over a long period of time a better world. Practically speaking, when these events have happened, and I can speak specifically to the most recent one, which was March of 2020, we use automatic rebalancing portfolios with our good friends at Dimensional Fund Advisors. So every day, and there was days in there where the market moved 10%. Well, you have a 10% market move and you're
a bit of balance.
50-50, all of a sudden you're 55-45. Well, it's automatically rebalanced. It's an automatic
daily, or it's like a rule based. Like if it goes above like 2%, you're balanced.
It's always real time because they're trading all the time, right?
Okay.
So it's not only between the big asset classes, stock and bond, but it's intra asset class. So
sure,
you have times where value does very well. So it's always rebalancing between value and small and around the world. And this is happening all the time inside portfolios. So that gives me great confidence. The risk we run is that we can look like cheerleaders, which to a certain extent we have to instill confidence, but there's a fine line between just blindly believing everything's going to be okay. But if you don't do that and say, "Oh, this time is different," which is so easy to say, right? You could go to clients and say, "You know what? I think it is different. Let's just go sit on the sidelines." Well, if you sat on the sidelines from March through to June,
it's always on retrospective. We are like probably falling in the same fallacy that we were complaining before. sometimes it will happen that this time is not different. How do you do? Like,
and that's why it's easy.
Sometimes you need to say, "Oh shit, maybe this time I should do something different."
Those are very expensive words, because don't forget, if you believe markets are working, markets should have priced in all known information.
Of course, I'm not talking about that. I'm talking about, hey, maybe this time that's a meteorite which is going to wipe out the earth. So maybe I better off get the money out and buy weapons and canned food and build a bunker or something like this.
Think about the meteorites you and I have seen in our careers.
That's zero, of course.
No. Economic. Are you kidding me?
Okay.
COVID.
Okay.
Some people say,
sure.
Donald Trump was a meteorite. I'm not making any political comment. I'm just saying some people said that. Right? You go back through time, different wars that have happened, all these things that have happened. The Greece debt crisis.
Yeah.
Like the SNL loans in the US, you've got 9/11, it goes on and on and on. The world's full of stuff like this, and it just keeps on going.
There might be something which is like a slower, a slower cycle, like, I don't know, every 200 years, like the Halley Comet or something like, I agree. US debt. US debt is always growing. If you could look at the past, it's always growing. Maybe one day, boom, will explode. Or
this is my point. Even more. This is risk. You're not guaranteed.
Climate change.
You're not guaranteed to get that risk premium. I agree with you. That is the point. That's where people kind of dump all over 60-40.
Yeah.
Well, may not be so bad to have some bonds.
Makes sense. In this mental space, is it worth, or do you diversify even outside financial assets, or like maybe at one point you should also buy something like more properties or physical gold or something more than just stocks and bonds?
That may be the case. Okay. Do I now? I mean, I have a property. Lisa and I own our home, and I've got investment in this business, which I realize is directly correlated to financial markets.
A bit, yeah. Okay. Well, there are like many amazing questions in the audience. Sorry, guys.
Fire away if you want.
I really would love to get them all, but no, this not. I still have a couple of questions I want to ask to you. So sorry, guys.
Time's flown by.
Yeah. What about? I know that you are an avid learner, so I love your presence in the. Even though you say, "Oh, it's mostly Ben," but I love your presence in the Rational Reminder podcast. You look to me the guy who reads more books than I know about. Maybe I have a friend who reads more books than you. Every time you happen to have just read another book, what are the books that impacted you the most in the last year? Can you mention 3-4 books? And a meta question, like another question. Do you think still reading books is a thing, something people do and should do? Because I myself find that with my attention being fragmented, I work online, it's complicated. I'm reading less books. So that's 2 questions, like one on the suggestions for more books, and if reading books makes still sense.
So I had a long discussion with a very good friend of mine about this, who used one of the AI models to give him a book review the way he wanted to understand the book in a format. And it was pretty incredible. He told the style of writing, how he wanted it formatted. And it took a few iterations to get there, but it is a wonderful summary of a book. I love the experience of my Kindle. My Kindle is a great friend of mine, and I love highlighting the notes, having it show up in my Evernote, and I clean up my notes and I try to review them. One of my commitments this year, I'm actually going to read less because I kind of felt overwhelmed by this almost waterfall of information. And yeah, I read 61 books last year. So what?
61 last year is more than one per week. How How does it? Yeah.
I read an hour a day plus vacations and flights. I had a lot of flights, so I enjoyed it, but I kind of felt empty because I almost feel I deserve
Too
the
much.
content deserves to be absorbed. And you think about it, well, 61 books is a lot, but there's probably 61,000 books published or something. So I'm still only chipping away at a fraction of the universe of books. So like once you realize that, so I've decided I'm only going to read. I'm choosing 24 this year, which is still a lot, but it's only one every 2 weeks. Old me of 6 years ago, I didn't even read 3 books a year. So, but to answer your question, ones that I loved lately, one is I read Fortune's Children, the story of the Vanderbilt family. Oh my gosh.
Okay.
It's a wonderful story, wonderful of how they made
Ends up very.
It doesn't go well. So there's one. A good friend of mine's book, Shane Parrish, wrote the book Clear Thinking, which
Clear Thinking.
Fantastic.
I think it's here. I have it. Yeah.
James Grubman's Strangers in Paradise. Oh, you understand wealth and what wealth does. If you end up having wealth that's different than what your parents had, or like if you have wealth and you're raising kids, you might be framed to raise your kids the way you were raised, which might have been more modest than your means now. So that means you're kind of they use this analogy of being, you think having all this money is paradise, but when you get to paradise, are you going to be like if you weren't raised with money, will you be acting like you're wealthy or acting like where you came from and the trade-offs? Oh my God, fantastic.
Interesting. I think I would read this one. Yeah. There's also I recently listened to one of with Charlie Munger being like dying. I read like binge watched some of his like talk, and I think once he was asked something like, "Don't you? Do you think that you might spoil your sons, your children?" Say, "Of course I would do, but if I don't do, they will hate me. So what the hell should I do?" Something like this. So
here's a good Chris. Do you know Chris Davis? Chris Davis was on Shane Parrish's podcast this week, and Chris Davis, investor in New York City, who was on the board of Berkshire and knows Charlie very well, and talked about how Charlie said, money doesn't ruin kids, people ruin kids. Which I thought was really interesting.
Okay.
Just to link to your point, that's a really interesting interview.
Okay, I will listen to it. Yeah, I used to be a member of the Finance Street community as well. Yeah. One thing about the book, I had a mental note I wanted to add to the reading conversation. Do you ever reread books? Because I don't. There are many like intellectuals who say it's better to reread the same 100 books several times.
Yes.
So
I'm starting to build a list of books I want to reread every year. So I just reread 10% Happier in preparation of Dan Harris' interview.
Of course.
It's a very compelling book on the benefits of meditation. So I am trying to meditate every day. Another one I've read a couple times, The Psychology of Money by Morgan Housel. Of course, it's a great book. So those are two that come to mind that are on that list.
Do you have any framework to better store your knowledge about what you read? Do you have a personal knowledge management system, like a note-taking, interconnected note-taking? There was a time 4 years ago, I went like deep diving into Rome Research, which is like a note-taking system, which is like, I don't know if you know about it, or other like Obsidian, or other ways to have like your own database of book notes or even personal like thinking about something you read.
So I use Kindle. I highlight with my finger notes. That goes into Readwise, which is an app.
Yeah.
And then it goes from Readwise into my Evernote. So Evernote has all my book notes in there. I go in and clean them up, and I regularly review a book or two every week or every couple of weeks, just to kind of keep it somewhat fresh. But Readwise is an app, and you can program it for how many past highlights it feeds you per day. So mine feeds me 10 highlights per day from different
Okay,
books.
so it's like a memorize. So essentially, it's like spaced repetition learning.
Yes.
So it pops up something per day randomly. Okay, makes sense.
And then it
Makes
learns
sense.
your habits, and it'll say, well, here's popular notes that other people have in the same theme that you've been reading. So it kind of intersperses ideas from other books. It's very, very well done app, in my opinion.
I remember reading, it's like maybe 10 years ago. There's another person I would love to invite on my podcast, which is Derek Sivers. I don't know if you know him.
Yep.
Okay, I think he's like an amazing thinker. And once he wrote a post about the topic list. So he reads things and then he summarizes things, but not by content, but by topic. So, for example, on happiness. And then, okay, I read on this book, this sentence, or so you get some vertical on some aspects. So you may say, okay, parenting, and then you get all the notes you extracted from different sources on the same topic. Do you try to connect things this way, or
I'd love to, but I don't. One thing I did, like after our conversation around designing our life, I printed off my notes and I keep, I don't know, 4 or 5 books, notes like this with me all the time. So I've read these notes countless times, like this, all dog-eared and stuff. You can see they're just my notes from that book. It had such an impact.
I used to do something. See, it's in the other room. I have a lot of printed, my own written notes. It's hard to get on them again because sometimes it's not top priority. But yeah. Wow, Cameron. There are like a lot of topics we didn't touch, but I think it's getting a bit too late. I will take one question from the audience, and for example, last one. There is this like let's jump on this last technical question. In the Italian community, like in the Italian YouTuber personal finance community, there is this debate between, hey, the US is overweighted compared to the rest of the world, so I'd rather stick to a more equal weight solution, which is never equal weight, but try to compensate for the dominance of like a few nations. Do you have any thought about this? Do you still think that market cap is the best way to go?
Equal weight is basically a value strategy.
What? Why? Oh, well, because you say, well, it's not guaranteed that countries with lower market cap, they have prices.
But when you're talking about underweight in the US's market cap is largely being driven by the high valuations, the growth stocks.
Good point.
Right? So if you're equal weighting or reducing your weighting there, that's effectively, you got to believe it's going to be more growthy than other countries. Otherwise, other countries would have kept up the same proportion, right? So I think it's kind of indirectly,
relatively. Okay.
You're making a decision based on price, which is a value play.
Okay. That I never thought about this way. So don't you, since you are like a quality, like a value lover, don't you use this information or in your planning, or do you? You maybe, yes, or something like maybe let's underweight US or other whatever.
So our weighting on our global portfolios is 1/3 in Canada, and then the rest of the world.
There's a lot of bias. Okay,
that's right. Then the rest of the world is market cap weighted. However, it's not. Each country is valued and size and profitability tilted in each country.
Of course, yes. Okay. Well, Cameron, it's been a pleasure. Thank you so much for having been here tonight with me. Sorry if it was a bit messy. Also, my English is degrading. I'm not talking English that much in these days. I'm mostly doing things in Italian language. And we didn't cover even 50% of all the questions I wanted to ask. But thank you so much. I really enjoyed our time together.
This was so much fun. And if people want to reach out, I love connecting on LinkedIn. If you have questions, I'm very active and love to hear from people if they do have questions or comments or feedback. And this has been a blast, Giorgio. So much fun. So great to see you. And I'm grateful for the work you're doing together. Like we're all in the same community here. We're trying to improve people's lives, do good work. You're only on the earth once, right? So we need a purpose. You know, the famous the Oliver Burkeman book, 4,000 Weeks. We'll try to make each week count. And
that's another book. It's in my list. As I see that too many things to do and too little time. About community, I recommend my audience to join the Rational Reminder community online. It's probably the most informative written, like text form community on the internet right now. Of course, in the video community, the top one is still Rational Reminder. And thank you again, Cameron.
You're very
Have a nice evening. And when PWL in Italy, I think I wish one day. Not today.
It's not in our current business plan. We have enough to do in our country here, but there's good people all around the world. And if people reach out, like we know, I'm not specifically Italy, but I know a lot of advisors in Europe in general. So maybe some of them do go to Italy. So happy to connect where possible.
Okay. Thank you, Cameron.
Stay well. Thanks.
Have a nice evening, everybody. Bye-bye.
Bye. Thanks, everybody.